Hello viewers, welcome back to our episode on advanced financial management, and today we want to look at the different forms of contracts or the Islamic financing structures, and we want to look at some of those that we had previously outlined in our last video, and we make sure that we give a detailed analysis of each of these different products that we have under Islamic finance. So the forms, one of the forms we have what we call, can start with musharaka, and we said musharaka is a form of equity. It's more of equity partnership. Now, we want to understand what this is all about. Now, this is more of a joint enterprise or a partnership structure where at least two or more parties bring in capital and skills. One person is to bring capital and the other is bringing the skills, and they want to trade in non-prohibited activities. So we have two or more people, one person here and another person this side. This one is going to be bringing capital, and this one maybe is going to be bringing skills. In terms of skills, we are talking about managing the business. These people, they can come together, they form a group. Maybe this is Charles and maybe this is Ivan. So they can form a partnership group, maybe CI partners. Then this one can be the one to manage the business when this person has just brought in the capital. So one brings in capital and the other is supposed to bring in the skills, because most of the times you may find that some people have the knowledge of how to do certain things, but they don't have the money to begin the business. Others have the money, but they don't have the skill that they can use to be able to do the work themselves. So what they do, you come together and then they start doing the business as two people, but one has brought in capital, the other has brought in just skills. Even the way they are going to be sharing the profits is going to be a little bit different. But the bottom line is the fact that we have one or two or more people coming together. One must be bringing capital and the other is bringing skill. That's the differentiating feature. They come together and they do business. So in this case, finance is provided by, at some point it may also happen that this person who is providing skill, maybe he has some small amount. He can also bring in some small money. Let's say he's going to be bringing in something like 20 million, maybe the other one is going to be bringing 50 million. So the whole lump sum capital is going to be 70 million. But on top, this person is actually bringing in, on top of the 20 million he has brought, is actually bringing in some skills. So they can come together and they start operating. So in this arrangement, if you find that everyone is going to be bringing in money, you find that both of them are going to be bringing in money, and at the same time, both of them are going to be involved in the management of the business, then we call that musharik. These terminologies, musharik, because everyone is bringing in cash and everyone is going to be engaged in the management of the business. Now, we want to look at the situation. How are they going to be sharing the profits, or the profits or losses, whatever they have achieved at the end of the period? So profits is going to be shared in a pre-decided ratio, and losses is also shared in the capital ratios. In other words, you look at the ratio. If this one, maybe this person has brought in, this one has brought in 20 million, the other has brought in 50. So the ratio is going to be 20 to 50. And that will be 2 to 5. That will be the ratio for sharing losses. Losses are going to be shared in profit contribution ratios. But when they are sharing the profits are going to be shared in a pre-decided ratio, or a predetermined ratio. So they determine based on whatever basis they have used. But what is key is for the loss. The loss should be shared in their capital contribution. So, whereas it is a joint partnership, even when you are providing management skills, you can bring in some money, because you may totally say that me, I'm not going to be having money, I'm only going to be contributing in terms of bringing in the skills. So if you are bringing in the skills, the argument is that you will not be sharing the losses, because losses are supposed to be shared in the capital contribution. If you contributed nothing in terms of capital, you are not sharing profit, you are not sharing losses, you are only there to share profits. Because there is no way we would say that we are going to penalize you for not managing the business well so that you can be able to make profit, because you sacrificed your skills to be able to make a profit, but you didn't make it. So if at all we have a loss, why are we charging you? At the end of the day, you had nothing. So that's their thinking, and it's a little bit, it's in that perspective as you can see it. So you are partners, but the losses are going to be shared in the capital you have contributed. So if you have brought in maybe 20 million, the other has brought in maybe 200 million, whichever the amount. But on top of the 20 million that you have added in, you are also bringing in the management skills. Then the other person may only bring in capital, because the other person can only say, me, I'm not going to be available. He brings in the cash, he says you manage the business. You bring in some cash, he brings in cash, but it's you manages the business. So once you make a loss, you share in the profit, you share the profit in a given ratio that you have agreed. But when it comes to a loss, you share in the capital ratio. So this is a little bit different from what happens from the conversion, these commercial banks that we know. Of course, for the commercial banks, as long as they have given you their money, whether you have made a loss, you have to pay. You have to pay them. Whether you have made profit, whether you have made losses, you have to come and pay their money. But for Islamic finance, they are saying, as long as you brought in skills, even if you have not brought in capital, when you make a loss, you are not supposed to share to be part of that loss, because otherwise you committed yourself by providing the skills that is needed to actually come up with business ideas that you can do with the intention of making more profit, because you had nothing. So there is no way they could be deducting money that you don't actually have, because in the first place you joined minus any money, which is a bit different. So that's what we have as musharaka. So I want to go to the next one. We look at what we call the mudaraba. Mudaraba is also partnership. It's also a partnership arrangement. But you want to understand how is it different from musharaka. Now, it's also a partnership transaction where one party supplies money. Now, this person is only going to be bringing in, we can have two people. We have two people. This one is bringing in 100% capital. Is the one who brings in capital. This one is bringing in 100% labor. This is just bringing in skills. Doesn't have any money. Now, what happens is that the person who is going to be bringing in money, the supplier of money, is what we call the Rab Arma. That is the person who supplies money. And the other person is what we call the mudarib, the one who supplies labor, mudarib. So this person is only bringing in labor. So now what's going to happen is the fact that these two people, this one is bringing 100% capital, then this one 100%. The mudarib is bringing 100% managerial skills. And now the partnership is mainly between two people, and it's called a mudaraba contract. Now, when these two people make profits are going to be shared in a predetermined ratio. Predetermined. In case of profits, once they have made profits, they are going to share in a predetermined ratio. They can agree on whichever ratio that they are going to use to share the profits that they have made. But now, in case of a loss, the loss is supposed to be 100% on the person who brought in the capital. The loss is supposed to be bared by this person, the Rab Arhma, the person who brought in the capital, is the one to suffer all the loss, because this person brought in nothing, because he had nothing. He sacrificed his skills and he put in the business. And the business, he didn't get any money, because when you don't make any profit, you don't expect this person to have anything, because at the end of the day, he brought in nothing. He just brought in his own skills. So if he has tried his best and he has not been able to be successful, there is no way you are going to say that the loss that I've suffered, because this person is going to be managing 100% of your capital. They will only be liable if at all they are the ones who led to that loss. Maybe they stole the money themselves, then they will be liable to pay. But if they have done everything in their powers to actually be profitable, but it never came out as a profit, then they are not supposed to be penalized for the loss that they have made. So we need now to get the difference between mudaraba and musharaka, because musharaka is also a joint venture, but mudaraba is specifically for two people. One is bringing in capital, the other is bringing in labor. Two people. The other one can be two or more people, but the two of them, each of them has to bring in some capital. This one can bring in like 20, the other one brings in the more, maybe 500 million, this one brings in 20. But on top of the 20, it provides skills. So I hope you are seeing the difference. So the other one is committing in mudaraba, one person is committing 100%, providing managerial skills with no money. But the other one is also providing 100%. He is not supposed to interfere into the operations of the business, because he's the one who has provided a capital. It's like the bank giving you the money and you go and start operating. When you make a loss, because the bank wasn't there when you made a loss, but if they go through into the causes of the loss and you are part of the reason as to why the business made a loss, then you find yourself paying. But if they find that it is 100% clear, you did the right thing, but things never came up, then you're not supposed to make any payment for the losses that are incurred by the business. And even this person is not supposed to, of course, pay you any contribution because you didn't make any profit. So that's the difference between those two items. Let's look at the third one, which is sukuk. Sukuk. We said sukuk is a lease arrangement. Sukuk, we said, is a lease arrangement. Sukuk. Sorry, sukuk we said is a bond. The lease is the other one called ijara. This one is a bond. Sorry about that. So these are Islamic bonds, and these bonds are structured in such a way that they generate return to the investors without infringing the Islamic laws. Of course, these are bonds but these bonds have no interest. In other words, you will not include any interest in these bonds. Remember, in the normal conversion banks, those commercial banks, they charge interest on these bonds. But for the sukuk, it will be structured in such a way that there is no interest. So the bottom line stuff here is no interest charged on the bond. No interest is charged on the bond. Now, what is the aim? Because if you are not going to have any interest, so what's the aim? So it aims at profit sharing by offering the investor or the owner, the person who is investing the money, is getting ownership into the business. The profit sharing is in the sense that I can give you the asset, only that you are going to allow me to be part of your business. You can be, maybe you are looking for, you want to construct your production factory, but you don't actually have the money. I can construct for you the factory, then I will be part of the business. I become part of, like we'll be owning the business together. And when we are owning the business together, it means we are going to be sharing the profits that we've made from using the manufacturing plant that I constructed. So the motive is just to share profits. In other words, you include the investor in your business or in your asset, because it could be a bank. I don't have the money to construct the factory plant. Then I go to the bank. The bank buys for me a building. Now the building is going to be mine. But since those people, they are not going to be earning interest, what they are going to do, they are going to make sure that they are part of the business, that the profits we've made in the business, we are going to be sharing them. If it is just an asset, if you are not in business and maybe it's me, I just want to go and buy land for myself, they can pay for you the land, but they are part of that land. Meaning whichever benefit you derive from that asset, you are going to share. Whether you buy the land and you leave it there for capital appreciation, it's not a problem. But the moment you want to say that you are selling it, just know they are part of that asset. So when they are buying, the asset is going to be like it is for two people. That's what we call the sukuk, the bond. It is structured in a sense that we don't actually pay interest. So whoever provides the money or whoever provides the bond, remember, for you, you provide a contract. And the owner of the money will give you the right to own shares in your company or in that asset. But what happens in the other commercial banks is that what they do is a bit different from what they do here. In these sukuk bonds, these are going to be linked to underlying tangible asset. These are basically on tangible assets. You are supposed to have a physical asset that you want to acquire. The asset is supposed to be there. So that's why for them they were saying that wealth is built on asset-based investments. So for example, it could be a bond that you are either maybe you are going to buy land or build a school. Therefore, the provider of the money must own. So, as you know that a bond is just a promissory note or a document which you can give out, or that the one they provide so that they can be able to receive money. And once money is received, then the provider of the money will wait for you to pay with the interest from the other commercial banks. But with the sukuk bonds, if the sukuk bond is, say, 50 million, then the next question that you are going to be asking is, what is it for? You want this money for what? Either buying land, building, machine, as long as there is a physical, tangible asset, then the money will be paid directly to the owner of that land. What is going to happen? The money is not going to be given to you, because when they say there must be a tangible asset, the implication is that I want 50 million, but you want it. What do you want that money for? I want to buy land. They don't give you the money. They just buy for you the land. In other words, there must be a physical asset that you are acquiring. If you want money to construct a school, then the bank will just construct for you the school. You just tell it where you want to construct the school, and they analyze everything to see how much is needed. They do the construction, or they pay the contractor who is going to be, so that there is an underlying asset. And that's why they are saying the money is backed by assets. So once they buy for you this asset, just know that asset is going to be owned by two people. And that's how it's going to be. No one is going to take it back. No, but you will be sharing profits that you are making from the use of that asset. So let's look at the other Ijara. Ijara, we said, is a lease contract. An ijara transaction is the Islamic equivalent of a lease, where one party, which is the leaser, we have the leaser, is going to allow the other party, who is the leasee, to use the asset against payment of what we call the rental fees. You'll be making either monthly or annual payments, and it's a mode of payment. But the bottom line is the sense that without interest, you will be paying rental fees, but without interest. And if you include interest, then the principal would have been killed. Then it wouldn't be an Islamic property. So when they are designing these rental fees, because someone is going to be asking, how do we benefit as a business, or how do businesses benefit, those banks benefit from these kind of transactions? Now, what happens is the fact that they may tell you that you are going to be paying maybe 20 million. That's the amount that you are going to be paying. But you agree that the two of you agree that instead of me paying maybe 20 million, I'm going to be paying 22. And you agree. Meaning the difference will be the income that the bank will have earned, so that they can keep operating. Of course, that 2 million will be, in a normal sense, it is an interest. But they don't call it an interest because it's not an effective interest, because it's in agreement. The two parties come together and they agree. But remember, the interest is always provided for. The central bank provides the interest rate. So that's why they are not calling it interest. But they sit and they agree and they see which amount that this person is going to actually add in to cater maybe the monthly monitoring fees. So they will just call it maybe monthly monitoring costs that are not basically the actual interest. Then we look at the other one, murabaha. Murabaha, we said it is a credit sale. So here, they sell to you goods on credit and you pay later. So a murabaha transaction is basically a deferred payment scale, or it's an installment payment, either hire purchase, something like that. So as long as they give you the goods on credit and you are going to pay later, that's a murabaha, and is mostly used in purchase of goods for immediate delivery on deferred payment basis. So in other words, you buy the goods, they give you the goods, but you don't pay the money there and then. It's different from where you order a car, then you wait for it to first reach, then you make payment. No. This one, they deliver, immediate delivery is supposed to be made. You buy the goods, they have delivered to you, you sell, then you pay back. Or you buy, then you keep paying in installments. In other words, if let's say I'm a construction company, it will come through maybe from the construction companies, and I need maybe 100 bags of cement. to construct a building. Because you're a construction company, you have contracted a building, but maybe the owner has not actually paid you the money. You can pick cement from a factory, you use the cement, then after the building has been constructed, this person pays you, and you also go and pay the other person that supplied to you goods on credit. It's the same that even the manufacturing process, whereby you get the raw materials on credit, then you pay when you have gotten money. So we can also look at what we call the salam contracts. Sometimes they write salam as this. So just understand what they are, and you base what they have given you in the exam. But that's what we are looking at. These are just contracts which are similar, like those forward contracts. Shall look at what forward contracts are. But just know these are also similar, like to those of forward contracts. Forward contracts. Now, we shall learn more about the forward contracts. But these forward contracts, most of the times we use them to manage foreign currency issues. In other words, if you realize that the exchange rate is fixed today, let's assume that maybe the dollar is 36, the dollar rate to UJX 36 shillings. If you realize that this dollar is fixed today, and you expect that the dollar might keep on changing or it might increase, then you can sign an agreement that you will be making payments at this dollar rate, fixed dollar rate. Because I may be demanding you maybe 15,000 US dollars. By the time you will come to pay me, the dollar rate, I was demanding 15,000 and the dollar rate was 36. By the time you are coming to pay me, the dollar rate has moved maybe to 38. Are you not seeing that you are going to be paying a lot of money? So you better sign a contract saying, I will pay you at this dollar rate of 36, such that when you multiply this times this, you will be paying that equivalent. But if you don't sign any contract, meaning you will be paying at this rate, where you will be making a loss, because you will be paying more than what you would have paid. So those are the forward contracts. We shall look at how we do some of those and how we can be able to manage losses, because this one would be good for the business that is receiving money. But just take, for instance, if you have people you have supplied on credit and they are paying you when the dollar rate has reduced, you gave them goods when the dollar rate is 38. Now they are paying you when the dollar rate is 36. I don't think that you are making a loss. So those are the forward contracts. We also have what we call the wakalah, the istisna. These istisnas, for them, they are just long-term. They are long-term in nature. Those large-scale construction, the wakalah. So there are very many aspects as you can look at. So the murabaha is just